Ever wondered why the market seems to trap traders before making a big move? It's not just luck or coincidence, it's a calculated phenomenon called inducement. In this video, we're breaking down exactly what inducement is, how it works, and most importantly, how you can use it to avoid traps and make smarter trading decisions. So, if you're ready to level up your understanding of market manipulation and protect your capital, stick around, this one's a game changer. So, what is inducement? Inducement refers to a deliberate move designed to lure traders into making decisions that provide liquidity for larger institutional players. It's a strategy used to trap retail traders, and unfortunately, many traders don't fully understand what inducement really is. Some even confuse it with liquidity itself. To make this concept crystal clear, let me use an analogy that perfectly describes what inducement is: a mouse trap. Imagine a mouse trying to eat cheese from a mouse trap. The cheese represents inducement, a tactic used by institutional traders to lure retail traders into the market and create trading activity. The mouse symbolizes early buyers or sellers who get drawn in by the enticing opportunity. But as the mouse tries to eat the cheese, it gets trapped. This represents the creation of liquidity, the stop-loss orders, failed trades, and impulsive decisions of retail traders. This liquidity is exactly what institutional traders need to execute their large volume trades risk-free. While the institutions profit, the trapped traders are left at a loss. Now that you understand the mousetrap analogy, let's take it a step further and apply it to real price chart examples. But before we dive into the charts, let me introduce you to FastBull, the ultimate platform that makes every feature easily accessible and incredibly simple to use. First up, let's talk about indicators. FastBull offers a lot of indicators, neatly categorized into different sections. And the best part? You can have up to 64 indicators on a single chart. FastBull makes it easy to trade directly through the platform. You can either create a free demo account or connect your own account with just a few clicks. And here's what sets FastBull apart: you get real-time quotes, something most platforms don't offer. FastBull's watch list is a game changer. You can add up to 1,000 symbols on your watch list, and they also classify the symbols into different instruments like crypto, forex, commodities, and more. Talk about a platform that's not just powerful but also well organized. My personal favorite? This taskbar. It lets you navigate through symbols effortlessly, and you can have up to 64 symbols on the same chart window. That's insane. And if you're a fan of multiple chart layouts, you'll love this feature. It allows you to interact with different symbols instantaneously, making your trading experience faster and more efficient. And the craziest part? All of this is completely free. So what are you waiting for? Click the link in the description, and let's explore these amazing features together on FastBull. Now, back to inducement. This is a live running trade on gold that we took on Monday using the concepts of inducement. In this example, this first order block represents the inducement. It acts as the cheese used by institutional traders to lure early buyers in. Retail traders place their stop losses below the order block, creating liquidity. The price then dropped to sweep this liquidity. At the retest of the extreme order block, institutional traders entered their large volume buy trades. This caused an instant push to the upside, leaving the trapped traders behind. There are three most common types of inducement in the market. Let's go through each one. The first type of inducement is an order block. In this example, price presented a clear order block, signaling potential buying opportunities. However, this turned out to be a trap, as most retail traders placed their trades too early. As always, they fell into the trap, creating liquidity that institutions capitalized on. The second type of inducement is equal highs or equal lows. In this example, we see equal highs, which technical traders often view as a resistance level, providing a good selling opportunity. Retail traders placed their stop losses above these highs, which created liquidity that had to be swept. Once the liquidity was taken, institutional traders executed their large volume sell orders, causing the price to drop instantly. The third type of inducement is a trend line. In this price chart, we can see a trend line with multiple touches. Traders using trend line strategies became the target here. Their stop losses, placed below the trend line, created liquidity. Institutions swept this liquidity and entered their buy trades at the extreme demand zone, leading to an instant push to the upside. Now that you know the different types of inducement, order blocks, equal highs or lows, and trend lines, let's move on to how to accurately identify inducement in the market. Let's take this example where you've identified a clear demand zone for possible buying opportunities. The key question is, how can you tell if this demand zone is an inducement or not? One of the most effective ways is to follow these steps. First, check for any imbalance or fair value gap below your demand zone. An imbalance indicates an area where price is likely to revisit before moving in the intended direction. Next, look for a clear demand zone at the extreme. This is often where institutional traders place their large buy orders to capitalize on the liquidity created by the inducement. Once you have these two confirmations in place, an imbalance and an extreme demand zone, you can confidently conclude that the initial demand zone is an inducement. Price will most likely break below it, sweeping liquidity on its way to retest the extreme demand zone. Let's revisit some of the price chart examples we looked at earlier to break down how to spot inducement in real time. In this example, for this order block to qualify as an inducement, we need to analyze what's happening below it. The first thing we notice is a clear imbalance right beneath the order block. This imbalance indicates inefficiency in price action that institutions are likely to target. Secondly, we can see an extreme demand zone just below the imbalance. With these two conditions in place, we can confidently conclude that this order block is an inducement. From here, patiently wait for price to sweep the liquidity below the order block and then place your buy orders at the extreme demand zone. On this second example, to determine if these equal highs are inducement, we need to focus on what's happening above this level. Above the equal highs, there's a clear imbalance in the price. Additionally, we observe a supply zone at the extreme, sitting just above the imbalance. These two confirmations, imbalance and the extreme supply zone, tell us that the equal highs are being used as inducement. Institutional traders will aim to sweep the liquidity above these highs, trapping sellers before placing their own sell orders in the extreme supply and driving the price lower. In our last example, for this trend line to be inducement, we need to examine the price action below it. Below the trend line, we notice a clear imbalance, followed by a demand zone at the extreme. These two elements confirm that the trend line is being used as inducement. The best strategy here is to wait patiently for price to sweep the liquidity below the trend line and then place your buy orders at the extreme demand zone. From these examples, a clear pattern emerges. To identify inducement, you must examine what's happening around the level, either above or below. For a setup to qualify as inducement, there must always be two key elements, an imbalance and an extreme supply or demand zone. Once you recognize these conditions, you'll avoid falling into traps and instead align your trades with institutional strategies, giving you a much greater chance of success. Now that we've covered all the important principles about inducement, let's make it fun. We're going to play a question and answer game to test your understanding. By the end of the video, comment your score below and let me know how many you got right. Looking at this setup, do you think this order block is an inducement or an appropriate zone to buy from? Pause the video and take a moment to figure it out. Alright, let's analyze it. To determine if this is an inducement, we need to check for two things. First, we can see that there's no fair value gap between the wicks of the subsequent candles. The market has pulled back and closed the gap. For this reason, we can consider this order block as an ideal zone to buy from. We then execute our buy orders, and price will most likely respect our setup. Take a look at this second price chart example. Would you consider this order block as an inducement or an ideal zone to buy from? Pause the video and try to figure it out. Let's break it down. First, we clearly see that there's an imbalance above the order block. Secondly, there's a clear supply zone at the extreme. With these two factors in place, we can confirm that this is an inducement and, therefore, unsafe to buy from. Institutions will sweep the liquidity resting above it. We aim to execute our sell orders at the extreme supply, and price will most likely push down and reach our target. Here's another one. Would you consider this order block as an ideal zone to buy from or an inducement? Pause the video and figure it out. Let's analyze. First, we can see there's a clear imbalance below the demand zone. Secondly, there's an order block at the extreme. With these two conditions in place, we can confirm that this is an inducement. We wait for the price to sweep the liquidity resting below it, and then we execute our buy orders at the extreme. For the last question, is this order block an inducement or an ideal zone to buy from? Pause the video and give it a try. Now, let's check it out. When we look below the order block, there's no clear fair value gap between the subsequent wicks. For this reason alone, we can conclude that this is an ideal zone to buy from. We execute our trades, and price will most likely respect our setup. Alright, that's it for the game. Out of 4 questions, how many did you get correct? Comment your score in the section below and let's see how well you understood today's lesson. If you found this video helpful, don't forget to give it a like, subscribe to the channel, and hit the notification bell so you don't miss future videos. Thanks for watching, and I'll see you in the next one.